Well, good morning, everyone. So we did the annual financial report for the auditors in their spring virtual conference, and some of the changes that are happening to our annual financial report, additional information on classification of receipts and expenses, and that PowerPoint is on our SBOA website on the county auditors page under presentations if you would like to see it. I'm going to provide some of the same information in this presentation, but a lot of the less technical on how to navigate Gateway to get this information in. Just to give you an understanding of the financial accounting and reporting, and specifically how your office fits in and supports that information. And as you know, as much as I love talking about internal controls, I also love talking about accounting in general. So please bear with me. I'll have Ricky keep track of my time and cut me off. Since we cannot see your beautiful shining faces, which I miss more than I can tell you, I also can't see when you lay your head down on your desk and pray for this whole thing to be over. But again, I'll watch my time and hopefully won't get in too deep in the woods. And then anyone who thinks, wow, I wish I could have heard a lot more about this, you have my phone number, so give me a call. Love to talk about this. We had some questions come through on some of the terms that we use that are not familiar, and we kind of bandy them around like everybody knows what they are. And so I included a screenshot. This is from our SBOA website, and I don't know if you were aware that it even is on there, but it's a glossary of terms that we use in accounting, and it provides the definitions of those terms. So I just wanted to point out to you where it is. So it's on the SBOA About Us, and then underneath that there's a glossary of accounting and audit terms. You can use the alphabet at the top to navigate. So if you're looking for GAAP, for example, you could click on the G. It would take you right to the top of the G so you can see, find the term that you're searching for and the definition thereof. It's a really nifty resource, so I just want to make sure you knew it was available. The basis of accounting refers to when revenues, expenditures, expenses, and transfers are recognized in the accounts and reported in the financial statement. Specifically, it relates to the timing of those measurements. In government accounting, we talk about three bases of accounting: cash basis, accrual basis, and modified accrual. So the timing is very important. It's something to remember in that, and that makes a difference between the type of basis that you're in. If a service has been provided for which a fee is charged, when do you recognize that fee as revenue? That's what I'm talking about in timing. When the service is charged, or do you recognize it when you actually get the payment of the fee? So your cash book is on a cash basis accounting. And kind of an example or an illustration, think about your tax billing cycle. Your assessor completes their assessment in the first part of the year. Budgets are approved that sets those tax levies and tax rates for the upcoming year. You guys send out bills in the spring of that year, but you don't record any revenue until the citizen comes in and pays their taxes, till you actually receive the payment. And that's what we mean by a cash basis. When the cash is received, you record it then on your cash book. The accrual basis of accounting would recognize the revenue when it is earned, or in the case of property tax, the time it's levied, which could be significantly sooner than when you actually recognize it at the cash basis. And this sets up a receivable account for taxes, and you may have heard of that, taxes receivable or just receivable in general. And when we're talking about accrual basis, you're going to see more of the receivables and payables. Modified accrual is accrual, but it brings some elements of cash receipts into the timing. It's just a little bit kind of a bridge between the two, and for counties, your governmental funds are usually done on a modified accrual. Again, it's not something you have to know in detail, but just so you have some groundwork for it, especially if your county is preparing GAAP financial statements. So not only your cash book, but your county's funds ledger is usually kept on a cash basis. As money is received, then the revenue is posted. So when a citizen pays a copy fee to obtain copies, the fee is receipted. The revenue line is then posted for copy fees. Okay? This would be shown as a charge for service on the AFR. In a similar fashion, if a service is provided or a good purchased by the county, the expense is not recognized until the county makes the payment. When a claim is approved and a warrant created, the expense is then posted to the funds ledger. So, for example, if you purchase an office supply, you receive that supply and you have a bill or invoice for the purchase. You then create a claim, attach the invoice, submit the claim to the auditor's office. They audit the claim, present it to the commissioners who then approve the claim, hopefully, and a warrant is generated to pay the vendor for the copy paper. The cost of the copy paper is posted to the general fund against your office's budget line for supplies and office supplies, and your appropriation is reduced at that time, and it's done at the time the payment is issued. You may have heard of a purchase order. The use of a purchase order can still be done on a cash basis system. In that case, the purchase order is used to encumber the appropriation against future posting of the payment. Large counties or schools often use purchase order systems to help their departments or individual schools track how much appropriation is available. However, purchase orders can also be used in an accrual basis system as well, because you can actually post the expense at that time if you're doing an accrual basis. So in the accrual basis, the service is provided by the county, but the payment is not received immediately. The expense is still posted with the receivable account to offset the revenue line until the payment is received. So a common example for counties would be your EMS billing. When the ambulance run occurs, the information on that run generates a bill for the cost of the service. This is submitted to insurance companies or to the individual if they're self-pay, and a receivable is created for the amount due. It may take weeks to months to actually receive that payment, but a record is maintained of all billed charges and accounts receivable for those charges. For a cash basis county, the income is not posted until the EMS remits the fees actually collected to the county treasurer, but the information is there to generate a receivable and determine the potential income. With our purchase order example, the purchase order could be used to create a payable when the good or service was delivered, as opposed to when the payment was actually issued. So most counties operate on a cash basis system and report on a cash basis system. However, those that produce GAAP financial reports or a CAFR report, they report on an accrual or modified accrual basis. One thing I wanted to talk about that also can affect your office's capital assets, because that's a new area that we're adding for all counties to report on. It's a change in the annual financial report. And that really is a timing issue as well. It's when you recognize the expense. So if you buy a large piece of equipment and that exceeds your capital assets threshold for the county, and that's going to be in your capitalization policy, you are going to add that item to the capital asset inventory for your office. The threshold is the amount above which you will capitalize or create the record of an asset. Below that threshold, you will just expense it, just like you do your copy paper or other office supplies. So if your county chooses a threshold of $5,000, you could purchase a laptop for $3,000 that you would not add to your capital asset inventory. But if you purchased a server, for example, for $10,000, that was above that, you would add that to your capital asset inventory. Every office and every department should have a capital asset inventory. And what does a capitalization mean? It means that you're going to use that item for more than a year, and you are allocating the total cost of that item over the years it will be in use. So if your server lasts 5 years, you would recognize an expense called depreciation of $2,000 each of the 5 years that it was in service. Under the enhanced regulatory reporting, the county will show a summary of its capital assets and a summary of its accumulated depreciation for those assets. However, that capital asset and depreciation will be in the notes of the financial statements and not on the face of the financial statements itself. For accrual basis accounting, the capital asset and cumulative depreciation would be in the balance sheet itself. So regulatory is the basis of accounting that the entity uses to comply with the requirements of financial reporting provisions of a regulatory agency to whose jurisdiction the entity is subject. And for the counties, it is by statute the state examiner who requires each audited entity, which would include all of the counties, to provide financial reports covering the full period of each fiscal year, and those reports shall be prepared, verified, and filed with the state examiner not late later than 60 days after the close of each fiscal year. Those reports must be in the form and content prescribed by the state examiner and filed electronically in the manner prescribed. This is what your auditor is doing when they're creating the annual financial report in Gateway. And that is a regulatory basis that we as the State Board of Accounts is the agency and the state examiner specifically that sets up how those reports are supposed to look. Okay, that would be unique to Indiana. It's set specifically within our state, so it makes comparing between other states or even across the world a little more difficult. And what GAAP does, that is generally accepted accounting principles. These are uniform minimum standards of and guidelines to financial accounting and reporting. And adherence to GAAP assures that the financial reports of all state and local governments, regardless of their jurisdictional legal provisions and customs, contain the same types of financial statements and disclosures. That makes them more comparable, and that is why for your regulatory agencies and others, readers of financial statements prefer the GAAP, and that's, again, why we're kind of moving that way with our enhanced regulatory. We have 17 counties whose population exceed 100,000 that are required to compile GAAP financial statements for audit before they can issue bonds. And that was a new change. And so this is the first year that a lot of the counties have been, of those 17 counties, are putting together those GAAP financial statements. So if you've heard the buzz about that, that's what it is about. And if you have any questions about it, don't hesitate to call and ask us. So governments usually or often use fund accounting. Fund accounting is an accounting system organized on the basis of funds. Each fund is considered to be a separate accounting entity. The operations of each fund are accounted for with a separate set of self-balancing accounts that are comprised of receipts, disbursements, and its investment and cash balance. So as treasurers, you are required to keep your own funds ledger. By statute, you are required to maintain separate from the auditor. This is a kind of a check and balance. The funds ledger that the auditor maintains, we consider that's what goes into the annual financial report. That's what we're auditing. But your keeping of that funds ledger is important as well because it helps to detect and correct any errors that might occur in posting of those funds ledgers. And that's why it's very important that those two reconcile, that they match. And if there are any variances, we ask you to research that with the auditor's office and get those corrected. That's why that is so important. The standard chart of accounts for Indiana counties is available on our website on the county auditors page under overview and chart of accounts. This includes all of the funds established by statute and the fund number assigned to those funds. There is also a separate document that lists the funds by fund number and the specific Indiana code that established this fund. So that is a great resource to have. I actually print it out and carry it with me most everywhere I go and use it probably, Ricky's over there not, I use it probably several times a day. So it's a good thing to have if you want to know what a fund was established for, what it can be used for, if you have questions about it. So the general fund, as you know, is your main operating fund for the county. So it can be used for any legal purpose. The special revenue funds are additional funds that are established to account for any specific purpose and are established either by legislation or local ordinance. In order to make a disbursement from county funds, there has to be sufficient appropriation, which is the permission to spend and comes from the budget, and there has to be sufficient cash balance in the fund. Your office's operating budget would usually come from the general fund. The budget sets aside a portion of the general fund balance to be used by your office for expenses such as personnel, supplies, capital outlay, or other operating costs of your office. If you do not use the amount appropriated for that year, the unused appropriation reverts back to the unassigned cash balance of the fund and then is available for appropriation for the next budget year. If you have a purchase close to the end of the year that will not be paid before the end of the year, you can encumber that amount so that the claim will be posted against your current year's budget and not your next year's budget, your subsequent budget. Encumbrances do need to be approved by your council at year end. One of the special revenue funds that you use is the Elected Officer Training Fund. This is, again, a special revenue fund where a fee collected by the Recorder's Office is set aside for the training of treasurers, auditors, recorders, clerks, and surveyors. For SEOA called meetings, the statute provides that the cost be paid from the general fund unappropriated balance, so that a lack of appropriation would not prevent you from attending State Board of Accounts called meetings. However, you also attend other training, and the Elected Officer Training Fund can pay for the cost of any training that is required by your continuing education requirements. It can also be used for designees of those elected officers now. We have had several questions come in, so what is the limit? How much can one office spend on that? That depends on your budget and your appropriation. The fund itself needs to be appropriated, and however much is appropriated, hopefully for a specific office of those 5 offices, is what you're available to use for the year. So if you take, you use it all in the first part of the year, you're not going to have any the rest of the year. So you're going to have to budget that out over whatever training you need to take during the year. Some additional funds are capital project funds. You get involved in this because they're usually established to collect the bond proceeds when you issue bonds for a big project. And your debt service funds are established to account for the amount needed to repay any debt that you have. Those are also funds that you should be familiar with. We've already discussed a little bit about the annual financial report. It's often called the AFR. It is a regulatory basis of reporting. It is completed, submitted, and certified by the county auditor. It can be found on the Gateway website. The annual financial reports are available for public access, so anyone can read those AFRs. You can go in and read the AFR for your county or any other county, city, town, township, library that you want to look at. The report is due 60 days after the end of the year, which is usually March 1st, unless there is a leap year, then it would be February 29th. And the submission of the report is required before DLGF can approve your county's budget. So it's really a very important report, and we want to make sure that we get that. What will happen once that's is placed, again, it's available for the public, but State Board of Accounts will run a macro on the information, which is a set manipulation of the data to produce the financial statements that we're going to be audited. This changes the format of the report, but it does not change any of, or should not ever change any of the underlying data. The county auditor will review and certify the financial statement is correct and ties back to the AFR and to their ledger. If any changes are needed to be made to the AFR due to the audit, those changes, called audit adjustments, will also be approved by the county auditor. Last year, we started training for changes to the AFR, which we call Enhanced Annual Financial Report changes. These changes were introduced to add some elements of GAAP accounting without all of the political subdivisions having to produce full GAAP financial statements. Most counties would be able to complete the work needed to produce GAAP financial statements. However, for some small towns and townships, the cost would probably exceed any added value of those statements. It was hoped that with added GAAP elements, the enhanced regulatory statements would be sufficient for users of the statements. And again, those users can be rating agencies, financial institutions, your citizens. Again, it's available to the public. People doing research nationwide can access that information for their research. So the additional elements that we added were a debt schedule, a capital asset and accumulated depreciation schedule, and some additional pension information. So users want to know how much has been invested in capital assets. By also providing accumulated depreciation, the user has a knowledge of how old the capital assets are and some idea of when they will need to be replaced. For example, if your capital assets are 80% depreciated, they are closer to retirement than if your capital assets are about 25% depreciated. Again, how much debt your county has is very useful information, necessary information when making financial decisions. If you look on our website, on the county's page, you will find the changes that were proposed for the AFR for 2019 and for 2020. Now, the changes for 2020, which include that capital asset schedule and accumulated depreciation schedule, has been postponed at this time due to everything we've been going through with the pandemic. It was just too much to take on top of everything else. It hasn't been forgotten, it's just been postponed. So you do need to be aware of it. And again, as far as the capital assets, which would affect your office, any office, you need to have an inventory of those. So what is the treasurer's role in the reporting process? First, as we've discussed in the past, when the auditor keeps the funds ledger, while the auditor keeps the funds ledger, the treasurer is the custodian of the cash and investments. Your cash book, as of the end of the year, shows all of the cash and investments that the county holds in both the funds ledger and the property tax and other tax collections that have been collected since the last settlement and have not been settled yet. This is a very important record. It should be kept current and it should be kept accurate. The cash book is a daily record of all money collected that is deposited into the county treasury. It reflects the daily receipts and disbursements, the total amount of cash and investments on hand, and a proof of the financial condition of the office at the close of each day. The financial report that you fill out each month is a monthly report that shows the financial condition of the office as of the close of the business on the last day of the preceding month. It is a summary of the amounts the treasurer has been charged with for the funds ledger and other collections, and also the credit of the deposit and investment balances that support the amounts that have been charged. This report also documents your reconcilement of the cash book with the bank and investment statements. This report shows every dollar you entrusted with and where those dollars are located, cash change fund, in the bank, in an investment. So basically, it's a report of your cash book along with your reconcilement to the bank and investment bankers. It's a very important report. At year end, in addition to the cash book and financial report, you complete the supplemental annual financial report form. The auditor has all of the funds information, and hopefully it's reconciled to yours so that we know that that funds information is correct, and that makes up the bulk of the annual financial report. But the auditor does not have the amount of property taxes and other taxes that the treasurer's office has collected since the last settlement. This amount must be included in the AFR. So with your reconciled cash book as of the last business day in December, you will add the property taxes collected by taxing district to the collections from all other sources that are accumulated on the cash book since the last settlement. If you were looking at the left side of your cash book, the amount shown for the funds, and again, this should agree with the auditor's ledger, and the remaining amounts of the cash book will be your, now, without the settlement for the funds, would be your after settlement collection. So it's the top part, it's your property tax collections, and then your other taxes before the funds ledger line. So the annual financial report, and that is again what we use to create the financial statements that we audit, shows the entire financial records of the county. And this slide is kind of just an illustration of how this complete picture works. The basis of the annual financial report is the auditor's funds ledger. That's usually uploaded into Gateway directly from your financial software. Added to that is the collections made by the county since the last settlement that have not been distributed to the county and other taxing units. And the treasurer's bank reconcilement would support those first two boxes, the auditor's funds ledger and the treasurer and cash and investment balances. You add those together, your bank reconcilement should support that. So your bank reconcilement is a part of every audit of the financial records. This is why it needs to be kept accurate and up to date. In addition to that information, there are other offices that maintain funds outside of the county funds ledger and keep money outside of the county treasury. These funds must also be accounted for on the AFR. The other offices and departments that have funds that are not included must also complete those supplemental AFRs that you complete to complete the picture of the financial records for the county. So you have, for example, the Sheriff's Commissary Fund, Jail Inmate Trust Fund, the Clerk's Trust Fund, the Clerk's Child Support Collections, the Tourism Fund if they have a separate treasurer, and the County Home Resident Trust Fund are just some of the examples. This is money that is held at the county by a particular office that is not part of the county treasury, but still must be included. And so they complete supplemental reports and turn those into the auditor. So as we have discussed, the annual financial report has to be compiled by the county auditor, showing the funds ledger as well as the supplemental funds held by other offices and departments. Again, most counties upload the information from the funds ledger directly to the Gateway. The information from the supplemental AFRs that are collected by the auditor have to be entered manually. Also, there is additional information that is required to be completed for the AFR, including the capital asset schedules, debt information, pension information, and federal grant schedules. When we prepare for the audit, the data is taken from the AFR and Gateway in a macro again. It's just formatted in the proper form that we want the audited financial statements to be for us to audit. So that form is completed to produce the financial statements and the notes to the financial statements. Again, while we change the format of the data, the financial statement and notes are based on the information in the AFR and Gateway. They come directly from that, and they should directly reflect that. This is a regulatory report, so the financial statements are formatted to meet the regulatory requirements, and this includes a financial statement that shows each fund, the beginning balance in the fund, the receipts and disbursements, and the ending balance for each fund. The notes would include the additional information on the capital assets, pension and debt information, as well as explanatory notes on the financial statement itself. Again, you can see actual regulatory reports that have been audited on the SBOA website, and on Gateway you can see the AFR. The regulatory report does not have a balance sheet and income statement that kind of combines that information into the financial statement and notes. A balance sheet would show the assets, or the cash basis, cash and investment balance, and an income statement would show the revenue and expenses for the reporting period, and we've kind of combined that into the beginning balance, receipts, disbursements, and ending balances. So when we start the audit, one of the audit procedures is to determine if the financial statement accurately reflects the financial position of the county. And these procedures have to include the Treasurer's Office. We will look at the bank reconcilement of the cash book to the bank and investment amounts. We will review your reconcilement for accuracy. Do the bank statement amounts tie back to the actual bank statements? Were all of the variances between the bank and investment and statements supported, and were they correct? And does the adjusted bank balance and investment amount tie to the cash book totals? Does the cash book reconcile right to left? Are you internally reconciling that cash book every day? Does the amount carried on the cash book for the fund's amount tie to the fund on the auditor's ledger, which is then traced directly to the AFR? The full evaluation would be total cash and investment balance of all funds, supported by the bank reconcilement of the treasurer, the clerk, the sheriff, and any other supplemental fund. But the majority of the reconcilement comes from the treasurer's bank reconcilement. The county financial report is stating to any readers of the report that this is the amount of cash and investments that we hold and how that amount is distributed or allocated among the various funds. It also states the total amount received and dispersed over the year and how that was allocated between the funds. Our audit is to determine if that statement is materially correct. Based on sufficient audit evidence, we can provide an opinion on the financial statement which tells the user or reader of the financial statement whether they can rely on the information or not. Okay, this is an example of an unmodified opinion, and this is what you want to see on your audit report. This opinion tells the reader or user of the financial statement, again, we're talking about banks and rating agencies, regulatory agencies, legislators, governing boards, and even your citizens, that this financial statement can be relied on when making decisions based on the information in the report. Those decisions can range from rating your bond issues, which affects how much interest you have to pay, to changes in laws, to management decisions by your governing boards, even how your citizens vote. So it's a very important report. There can be modified opinions as well. We really don't want those. They do happen. You hopefully never hear about it, but an adverse opinion means that we do not believe that the financial statements present fairly the financial position, and we state that. There also can be some modifications where we disclaim the opinion, or we limit, because we have a scope limitation during the audit, we may limit what we're reporting on. So with the exception of capital assets, everything else is fairly stated, capital assets are not, something like that. How am I doing? You're good? You got 12 minutes. I got 12 minutes. Cool. Okay, one of the questions that came up through was to explain debits and credits. So I put this in here just for fun. So hopefully this is fun, I think it's fun, but you know, with the classic joke my son gave me, accountants aren't boring, they just get really excited about very boring topics. So this is fun for me, tells you about my life. So a debit means left and a credit means right, basically, in the accounting. The left side of the equation, the right side of the equation. So I put a sample journal entry, if you were to do journal entries, and this is for a cash receipt, and it's an example of a dual entry when you hear about double entry accounting. The payer, in this case, pays $500 for a service or fee from the county. So the cash book, you would quiet at $500 following the appropriate receipting process, which we can go over if you want to, but we're hoping you don't, because we all love it so very, very much. So you will post the $500 to the general fund, and also to the fund that ends up getting into your fund ledger line as a quieted in amount. If you were doing a double entry accounting, you would debit cash, which is the left side, you're looking face on, and credit the revenue line. In this case, the charges for services, which is $500. Debits must always equal credits in order for you to have a balanced reporting or equal balance entries. I don't even know. It's just for it to balance. Debits have to equal credits, but just drum that into you. So debit again means left, credit means right. So in our example, debit is the left-hand column, credit is the right-hand column. The amount's exactly the same because debit has to be credits, and I gave you a very simple example. And depending on what account you're posting determines whether a debit is an increase or a decrease. So for asset accounts like cash, debit increases the asset, which means that your total cash account has been increased by the $500. And in this case, your revenue line has also increased. So revenue is increased by credit. If you were to pay something out, you would have the reverse of this, whereas you would have a credit to cash because you were making a payment, and it would reduce the amount of cash. You would have the debit to an expense, and debits increase liability accounts. Okay. So here's my fun little question. If a debit increases cash and a credit decreases cash, why does the bank debit your account to remove cash, like a bank fee, and credit your account to add cash, like interest? I know you're all thinking this out. I wish I could see you. Hopefully not asleep. And the answer is because the bank statement is literally that. It's the bank's statement. And for the bank, your account is a liability, an amount they have to pay out to you. So a debit increases that liability, the payout, and a credit decreases that liability for the amount they have to pay out. And I didn't use this example just to mess with your mind. I wanted to make a point because we have often had this conversation, not necessarily with treasurers, but with all offices. When the State Board of Accounts says the bank statement is not your record, this is why. The bank is recording the transactions for their records and providing a monthly report on the status of your accounts back to you. They're making a report to you, but it is from their perspective. And from their perspective, your account is a liability. And so that's why debit and credit, which you're thinking, now they've got it backwards, why it is backwards for that. Because they are doing the exact opposite. An increase in cash for you is a decrease in revenue, or if it's interest, for example, it's a decrease for them. When you reconcile, and reconciling is very, very, very important, it is the fundamental part, and I hope I made that point earlier, when we come into audit, is the reconciliation that you guys have, the Treasurer's Office has, that really is crucially important during the audit. When you're reconciling, that is the process of comparing your financial records, your cash book, your funds ledger, to the bank's records, the bank statement, or the investment records, which would be the investment statement. The bank statement supports your financial records, especially when they agree, which we want them to. But the reconciling is, as we discussed, extremely important. However, never think that the bank statement is part of your financial records. It is not. Your financial records are your cash book, your funds ledger, your monthly reports. And I hope that's clear, and I can't see you to ask. And we made it through. I enjoyed it. I hope you did as well. If you have any questions, don't hesitate to reach out to us. Again, love to talk about this stuff. We'll probably put you to sleep with it, but more than willing to talk anytime you want. You can reach us at the counties at scoa.in.gov. We usually make a plug for that. Ricky and I have individual email addresses, and you can email us at that. But if you do the counties, it's more likely that when one of us is not here, the other will pick it up. And so if you happen to pick a day that one of us is not working that day, it could sit a little longer. So we just encourage the use of the counties folder. And our phone number is on there as well. And if there are any questions coming in?
Not yet. I thought I might give them
They're all eating donuts, and they're in a sugar coma.
Yeah, far. Okay.
Let's see if I can unshare here.
We're just moving right along today.